The Vienna Resolution nobody saw. It unfolded without panic, without headlines, and without a single dramatic moment to mark its beginning. While markets focused elsewhere, a quiet resolution was taking shape in Vienna, one that would determine the fate of an entire banking structure before anyone realized it was at risk. To understand how Austria resolved a banking threat without triggering alarm, we must return to a system defined by discretion. Austrian banks had long operated across borders, threading themselves through Central and Eastern Europe with confidence built on relationships and reach. This expansion brought opportunity, but it also created complexity that few outside the system fully grasped. Stability depended not on size, but on coordination. The story begins with an institution whose balance sheet spanned jurisdictions with very different economic rhythms. Profits in one region masked weakness in another. Internal transfers smoothed volatility. On paper, the group looked resilient. In reality, it relied on constant internal alignment to remain so. When external conditions shifted unevenly, that alignment began to strain. Regulators noticed early. Stress indicators did not point to imminent failure, but they revealed something more concerning: deterioration that would accelerate if left unaddressed. Waiting for a visible crisis would mean acting too late. Acting publicly would risk creating one. Vienna chose a third path. Behind closed doors, authorities activated resolution planning not as a contingency, but as a process already underway. Asset quality reviews intensified. Legal structures were mapped. Loss-absorbing capacity was assessed quietly, without signaling distress. The goal was not rescue. It was order. Inside the bank, leadership was brought into the process with unusual candor. The message was clear. The institution would not be allowed to drift into failure, nor would it be publicly propped up. The solution would be decisive, structured, and contained. Compliance was not optional. As preparations advanced, the bank continued operating normally. Depositors saw nothing. Markets remained calm. Yet beneath that calm, control was shifting. Decisions that once belonged to management were now being framed by resolution logic rather than growth strategy. The brilliance of Vienna's approach lay in its timing. Intervention came before fear. By the time the outcome became visible, the danger had already passed. And when the resolution finally surfaced, it would feel less like an emergency and more like a quiet inevitability. The process advanced through layers of preparation that rarely attract attention until they fail. Capital instruments were examined for true loss-absorbing capacity. Intragroup exposures were isolated. Contingency funding plans were stress-tested under assumptions far harsher than any public scenario. Each step reduced uncertainty, even as it increased pressure behind the scenes. Inside regulatory circles, coordination was meticulous. Austrian authorities worked with counterparts across borders, aligning expectations before action became necessary. Jurisdictional conflicts were resolved in advance. Legal triggers were clarified. The goal was simple but ambitious. If resolution occurred, it would unfold seamlessly across regions rather than fracture along national lines. Within the bank, operations continued with studied normality. Lending proceeded. Payments cleared. Employees followed routine schedules. Yet at senior levels, the tone had shifted. Growth initiatives were paused. Divestment options were evaluated quietly. Assets that complicated resolution were marked for separation. The institution was being reshaped while still in motion. What made this phase critical was invisibility. No announcement accompanied the preparations. No signal invited speculation. Markets priced fear faster than facts, and Vienna refused to offer either. The system's strength lay in denying room of the space to grow. As weeks passed, stress indicators stabilized, not because conditions improved, but because risk was being contained internally. Capital buffers were repositioned. Exposure was reduced deliberately rather than reactively. The bank was no longer drifting toward failure. It was being guided toward resolution without the word ever being spoken publicly. International observers remained unaware. Ratings unchanged. Spread steady. Confidence intact. The absence of reaction was the proof of effectiveness. Resolution planning had matured beyond emergency response. It had become preventative governance. Inside Vienna, Officials understood the stakes. A visible failure would test public trust and political tolerance. A silent resolution would preserve both. The choice had already been made. The question now was not whether action would occur, but how quietly it could be completed without disturbing the system it was meant to protect. The decisive moment arrived without ceremony. A prearranged legal threshold was crossed quietly, triggering a sequence of actions that had been rehearsed but never announced. Ownership structures shifted. Certain capital instruments were written down. Control moved decisively from management to resolution authorities, all within a framework that had been prepared months in advance. To the outside world, nothing appeared to change. Branches opened. Digital platforms functioned. Counterparties settled transactions as usual. Yet beneath that surface continuity, the institution was no longer operating under its former identity. Losses were being absorbed exactly where the models had predicted. No taxpayer funds were deployed. No emergency liquidity was requested. The system held. Inside the bank, the shift was unmistakable. Senior leadership transitioned out. Governance tightened instantly. Decisions were no longer strategic. They were structural. Assets marked for divestment moved into execution. Cross-border exposures were reduced with coordination that would have been impossible under crisis conditions. What would have been chaos in public became order in private. Regulators monitored every step in real time. Their concern was not solvency alone, but confidence. Any operational disruption could have unraveled months of preparation. None occurred. The resolution unfolded not as an event, but as a process already in motion, now revealed only through its outcomes. Markets noticed subtle changes after the fact. Certain instruments disappeared from trading. Balance sheet disclosures shifted tone. Analysts adjusted assumptions without urgency. There was no shock to absorb because nothing had broken visibly. The resolution had preempted drama. For policymakers, the episode confirmed a hard-earned insight. The most effective crisis actions occur before crisis becomes observable. Waiting for fear to justify intervention only multiplies cost. Acting early, quietly, and with structure preserves not only stability, but legitimacy. Vienna had executed something rare. A resolution that felt anticlimactic. A failure that did not frighten. A correction that did not demand rescue. The institution survived in altered form. The system remained intact. And Europe moved on, largely unaware that a major threat had been removed without spectacle. But for those who understood what had happened, one truth stood out. Resolution does not have to be loud to be decisive. Sometimes, the absence of panic is the clearest sign that control was exercised at exactly the right moment. The aftermath unfolded with the same restraint that defined the resolution itself. In the weeks that followed, disclosures confirmed what insiders already knew. Losses had been absorbed where risk belonged, operations have been stabilized, and contagion had been avoided entirely. There was no emergency legislation, no public bailout, and no political crisis to manage. The system had corrected itself before fear could take hold. Vienna's approach quietly reshaped expectations across Europe. Resolution was no longer viewed as a last resort triggered by visible failure. It became a tool of governance, applied early enough to prevent collapse rather than respond to it. Authorities demonstrated that credibility is preserved not by denying weakness, but by addressing before it demands attention. Inside the restructured institution, normality returned quickly. Employees adjusted to new governance. Clients experienced continuity rather than disruption. The balance sheet shrank, but it stabilized. What mattered most was not growth, but trust. And trust, once preserved, does not need to be rebuilt. Regulators across the continent absorbed the lesson. Resolution frameworks were refined. Planning accelerated. Institutions were reminded that silence does not mean safety, and that intervention does not require spectacle. The Vienna case became a reference point, not because it was dramatic, but because it was effective. The broader implication was unmistakable. Financial stability is not only about strength under stress, it is about timing. Act too late and panic dictates terms. Act too early and legitimacy erodes. Vienna acted at the narrow point where control still outweighed fear. The resolution nobody saw left behind something rare in financial history: a correction without chaos, a failure without fallout, a demonstration that discipline, when applied quietly and decisively, can protect systems without shaking public trust. Sometimes the smallest shift in perspective becomes the beginning of a new future. The